Should you buy a house in St. Augustine, Florida in 2025? I'm sure you've seen from the news or YouTube that there's plenty of doomers, as we like to call them, that are predicting that the housing market within the state of Florida is either going to crash, inventory spiking, and prices are going down, and there's nothing that we can do about it. And in today's video, what I want to do is actually address some of these concerns head on and take a look at the data and put some context behind what they are saying and try to prove or disprove them in this video so that you can know if it's a good idea to buy a home in St. Johns County in 2025. What's up, everyone? It's Thomas with Real Broker here in St. Augustine, Florida. And if you're looking to buy, sell, or invest here in St. Augustine, make sure you reach out to me and my team. All we try to do is give you the information so that you can make an educated decision on what you want to do, which is buy, sell, or invest here locally. So in this video, I want to start off by looking at the market influencers, taking a look at the unemployment rate, taking a look at inflation and mortgage rates to really see what is going to push or pull our market forward or backwards. We're also going to take a look at the St. Johns County market data so that you have a better idea of what's going on here locally. And then I'm also going to give you my insights and what I think is going to happen here in 2025. So to start everything off, let's take a look at the unemployment rate of Florida and compare it to the United States. So when we're taking a look at the United States, the unemployment rate across the entire nation is going to be 4%, which is honestly a great number. It's lower than historical averages, so we can't complain too much there. And then when we take a look at the state of Florida, we're going to see that we're coming in a little bit lower than the nation. The unemployment rate in the state of Florida is 3.6%, so Jacksonville's probably following along there as well. Actually, the city of Jacksonville, which St. Johns County is a part of the Jacksonville metro service area, we're kind of a large suburb of Jacksonville in a way. Our unemployment rate in the area is actually going to be 3%, the state of Florida, but we're also beating the nation in terms of unemployment rate. And I think that has to do with a variety of factors. Florida's economy has grown tremendously since the pandemic, and northeastern Florida and Jacksonville in particular has also grown pretty significantly over the last couple of years. But if we take a look at job growth in the state of Florida versus the rest of the country, we're going to see that year over year job growth has grown about 1.7%, which when we're talking about if you can buy a house or if you can't buy a house, having a job that pays you well, that is going to be pretty consistent and comfortable for you, is going to be one of the main factors of if you can afford a house or not. The next thing that we want to talk about is going to be inflation and also mortgage rates. As we know, that is also going to affect the cost of what it is for your monthly payment, right? When we're typically seeing inflation go higher, we're typically seeing mortgage rates follow that. And we had some major inflation since the pandemic. That's just what happens when you print a whole bunch of money. And we started to see it cool down over the last couple of years, which is a benefit for everyone, but also for mortgage rates. So when we take a look at mortgage rates on the average 30-year, we're at 6.6%, which people are wondering, is that a good interest rate? Well, when you look at the historical averages, now of course pricing has changed tremendously over the history of the historical averages, but when you're looking at the historical average of interest rates, we can see that the average is 7.5%. So a 6.6% interest rate is still below the historical average, which in general is a good thing. But I know many of us would like to see those rates go further down, and I think we may see rates go down because as of right now, it is in a downtrend. And the one thing that's really keeping mortgage rates from going down and the federal funds rate from going down is going to be CPI. And if we take a look at CPI, it's right now at 3.2%, which is about 1.2% away from the Fed's target of 2%. So we still have a good bridge to gap, but overall it does seem like inflation has kind of cooled a little bit and it's stabilized around the 3% level. Now, all of this is important because the federal funds rate doesn't necessarily correlate directly with mortgage rates, but it does influence it pretty significantly. So how does inflation correlate with mortgage rates? And we're going to start by going back a couple years. We're going to take a look at what happened during the pandemic. We saw the Fed lower the federal funds rate to the lowest amount possible, which is essentially what people can borrow at, right? So they lowered that to really combat what had happened because we had a huge drop off in terms of the economy because the economy shut down for a couple of months across the United States and the world. And during that time, we printed a whole bunch of money. So inflation really started to rise with that. And the way that the Fed can battle inflation is by raising that federal funds rate. So in order to keep inflation tampered down and to bring it down to that 3%, the 2% where they want to be, they had to raise the federal funds rate. And they did so pretty significantly within a short amount of time, which really put a shock to the market and slowed the housing market down pretty significantly. Now, the federal funds rate doesn't necessarily correlate with mortgage rates, but it does affect the 10-year Treasury yield. So when you take a look at the 10-year treasury yield and mortgage rates, they typically trade at about 3% of a difference. So if the 10-year treasury is at 3%, then you could expect to see mortgage rates at 6%. And if you look at the historical data, they kind of dance with each other and go back and forth, and they're trading within that range. So whenever you change the federal funds rate, you're going to change the 10-year treasury bond, which then is going to affect mortgage rates. So once inflation went up, they raised the federal funds rate, the 10-year treasury went up as well, and then mortgage rates correlated with all of that. So there's no real indicator that is going to say like, hey, the Fed is going to 100% lower the federal funds rate this month, or they're going to raise it. They kind of do everything in a reactionary basis. So if the economy is not looking good, they may lower the Fed's fund rate. If the economy is doing too well, they may raise the federal funds rate. So there's not really a great indicator on that. But we do have the Atlanta Fed, and we also have the market and what they think. And if we're taking a look at what the Atlanta Fed says, they're thinking that they're going to do a 0.25% rate cut in March. And if you take a look at what the market is saying, they're saying that there's a 98% chance that the Fed holds steady. And we're already past the point where the Fed made the decision. The Fed held steady. So the Atlanta Fed and their prediction was wrong, and the market was actually right. And the market's saying like, hey, we're expecting the Fed to cut rates 3 times this year. Initially, it was only 2 times, but now they're expecting it to be 3 times because of the fears of recession. Now, the market is expecting 3 cuts from the Fed this year. And if it happens, we could see the federal funds rate being somewhere between 3.5% to 4%. If we take a look at the historical averages of mortgage rates, it's typically going to be about 3% over the federal funds rate. But there's a whole bunch of other data and factors that are in there that we're expecting to see interest rates be somewhere between 6 and 6.5% by the end of the year. This is a great thing for buyers as it lowers your monthly payment pretty significantly when you take a look at 6 versus 7% interest rate. But it's also a great thing for sellers as well, because especially here in St. Johns County, where we have seen active inventory go up, that's going to bring more buyers into the market as it becomes more affordable. And like I said before, the mortgage interest rates really base themselves off of the 10-year treasury. So when we take a look at the 10-year treasury, we can actually see that it was on an uptrend at one point, but now we're starting to see that 10-year treasury rate go down, which is a positive thing for interest rates regardless of what the Fed does with their federal funds rate. And now that we covered the influencers in the market, these things are going to affect housing market nationally and also locally here in St. Johns County. I want to take a look at the Jacksonville metro service area so that we can go another step down and take a look at like what's the greater area doing, and then we're going to take a look at St. Johns County. Okay, so what we're going to do is I'm going to give you a quick wrap up of what's going on here in our market locally for February. So when we take a look at February closed sales, you can see that 61% of sales were between 200 and 500,000. The average cash sales was 26%, which was down from 29%. And typically in our market, we're seeing about a quarter of our market is cash. The sold to original list price is 94%. So if you listed a home at $1 million, you could expect that your home on average is going to sell for $940,000. 39% of the properties had concessions of at least $10,000, and they're saying that new construction contributed about $18,000 to the deal to get to the closing table. And overall, in the Jacksonville metro service area, new construction was about 25% of our market. Where here in St. Johns County, it's actually I think it's about 35% of our market. So pretty big jump when you're looking at new construction here in St. Johns County versus the general area. And when we're talking about new construction, how large of a portion of our market they make up, it's very reflective in the top sales of the top 15 zip codes in our entire area. And when you're taking a look here, you can see that St. Johns County makes up 6 of the 15 top zip codes in the entire Jacksonville metro service area. And that is greatly due to the new construction here in our area. So we see the top zip code is 32092. So that is going to be where the majority of new construction homes are going to be. It's really where all the development is happening in St. Johns County. It's going to be in that northwestern part of St. Johns County where you have Silverleaf, you have Shearwater, you have Rivertown, you have Trailmark, you have a whole bunch of brand new communities up in that portion, and all the schools are new, all the commercial retail development is new. It's just a brand new area where they had a whole bunch of land and they're able to put a community like Silverleaf where they're going to eventually have 18,000 residences within that community. Now, when we take a look at our market, seasonality is a factor. We typically have our hottest part of the market between March and the end of summer, and our slowest part of the market is going to be October to February. So we're just coming out of that winter slumber, that we really see a slowdown in the market, and it's getting pretty sleepy around here. So really, March to the end of the summer is when you're going to see peak pricing and peak activity. So when we take a look at active listings in our market, you can actually see that we're trending above the historical average for our entire area. And that's probably pretty normal for the entire state of Florida. And then we take a look at seasonality, we take a look at pending sales and the historical averages there. As of right now, we haven't gotten the full numbers for February, and March is going to come out here pretty shortly, but they always get revised as well, at least a month down the road. So it's a lagging indicator, and that's because, whether it's the builders that aren't putting in the information, or it's the real estate agents that aren't putting in the information, or it's just the homeowners that aren't inputting the information in the MLS because they sold off market. There are a variety of factors why these numbers get revised. But from what we've seen historically is that these numbers tend to be higher than what we're seeing actively put onto the market right now. So if you take a look at January, you can see that that was 1,805. And actually, when we first got the numbers, those numbers were 1,700 closed or pending sales. So that means that we saw about 100 homes different that were actually closed. We're expecting the same thing to happen in February. You can see that you have 1,586 in February, where we're actually below the pending sales of what we would expect for this time of year. But if it were to be revised, you could actually see 1,980 sales. So that would be on trend and above the historical average of what you would expect. And pending sales is a great indicator of what's going on in the market right now, but not every pending sale makes it to the closing table. And when you take a look at closings in the entire Jacksonville metro service area, you're going to see that closings are actually above the historical seasonal pattern, which is, once again, another good indicator that our market's doing just fine, and that if you are looking to buy here in St. Johns County or anywhere in northeastern Florida, it's more than likely going to be just fine for you, and you're going to see appreciation. Another indicator in seasonality is going to be median sale price, and if you take a look at the chart here, now it restarts every single year, so the bottom is January, and the top is normally in June, July. You can see that we're actually on track in terms of our median price appreciation throughout the entire northeastern Florida area. So let's wrap all that up, put a bow on it. Let's just take a look at median sales price since 2002 so that you can have a good idea of what we're appreciating at year over year so that you can see if you can make a good decision. Now, in general, if you're looking at Jacksonville, 84% of the time, your home is going to be more expensive the next year, and that data tracks all the way back to 1980. But when you're taking a look at appreciation year over year since 2002, we've seen that on average, a home is going to appreciate in the Jacksonville metro service area at about 5% per year. And then when you compare that to the affordability and if a market's overvalue or undervalue, you can actually see that we're pretty much right in the Goldilocks zone, which is we're just right where we need to be. So you can see back in the early 2000s, we were technically overpriced, and many areas were, right, considering what they were doing with loans, pretty much giving out multiple loans to people who could not afford them. And then we had the great financial crisis. Everything started to tumble down, and things were dirt cheap here in St. Johns County. I wish I would have bought during this time, but I was a dumb college kid, and I didn't know anything. I didn't have a great job either. So you can see today that we did go over that historical average for median sale price when you're just flatten the curve a little bit. So we were technically overvalued here, but it's since come down back to reality since the mortgage rates have changed pretty significantly to where we're right where we need to be in terms of a 5% appreciation rate year over year. So let's take a look into St. Johns County and see how it's comparing versus the state of Florida in terms of inventory and also median sale price. Okay, so if we take a look at active inventory, this is going to correlate with what the doomers are saying, and that the housing market, the inventory, it's going to crash, and that inventory is increasing pretty significantly. And they're right. When you take a look from 2022 to now, you're going to see a huge increase in inventory. So let's take a look at the Florida active inventory, and this is going to correlate very well with what all these doomers are saying, is that inventory is piling up and that there's going to be a market crash, and that it's 1,100% increases month over month in terms of inventory. When we take a look at the Florida active inventory since 2022, you're going to see that they're right. So if you take a look at February of 2022, we were roughly just under 30,000 homes for the entire state of Florida. That is an insane number. And then if you look at February of 2025, you can see that we're at about 110,000 homes for the entire state of Florida. So face value, that is a tremendous increase. That should scare you a little bit, right? But I think what we really need is context. We want to zoom out a little bit and take a look at Florida as a whole. So if we take a look at the Florida active inventory back in 2022, you can see that we have just under 30,000 homes for the entire state of Florida, which I can't believe we were in that market at one point. It was really a crazy time. And then when you compare it to today, in 2025, we have just under or just around 110,000 homes. So a huge increase over the past 3 years, which when you look at it at face value, you could agree with the doomers. It's pretty shocking. You're like, oh my God, what is going on? But I think the best thing to do when you're taking a look at this, to add some context to it, is zoom out a little bit more. You know, the housing market's been around for a lot longer than 3 years. So what does it look like when you go back 20 years? Let's take a look. Okay, so I couldn't exactly go back 20 years. The computer system doesn't have that data logged into there, but I could go back to 2008, which we could all agree is probably a pretty significant point, right? So when we take a look at 2008, you can see that we were hovering just above like 230,000 units of inventory for the entire state of Florida. And when you compare it to today, the 110,000 doesn't seem that bad, right? Because that's half of what they had in 2008. And then if you take a look at what our market did since really 2012, we're kind of in the same boat as what we were there. And we saw appreciation essentially since that time period. So this is the biggest thing. Yeah, when you take a look at 2022 to 2025, that's a scary jump. But when we have the lowest inventory that we know of in history, we're going to have a little bit of a rebound from that. And that's what we're seeing here. And that's what I believe we're seeing here. So let's do the same thing and let's compare that to St. Johns County and take a look at their active inventory. So when we take a look at the active inventory in 2022, you can see that it was extremely low. We had just above 500 homes at that time, which once again, it was a crazy market. You wanted to see a home, we had to see it that day. We had an offer in the next day, and pretty much all your contingencies were taken off. So as a buyer, it wasn't great. As a seller, it was fantastic because you had multiple offers on your home, and it was more than likely selling above asking price. So then you fast forward to today and you're in 2025, you can see that our inventory has, multiplied times 4, right? So we're essentially at just under 2,500 homes here in the area. And when you look at that number, once again, it does give you that shock value. It makes you a little bit scared about what's going on in this market. But what I will say is this is a normal market and this is what we wanted, right? In 2022, people were praying for this. People that couldn't get their foot in the door literally for many of these homes were like, man, I wish it would just slow down a little bit. And it slowed down more than a little bit, which is honestly a good thing for buyers. Maybe not so much for sellers, but if you are a buyer that was on the fence or maybe you got beat out all day long in 2022 and 2021, then this is a good time for you to buy. And just so you guys know, I bought a home in 2023. I lost 4 offers before I actually got into a home that I wanted. And that was extremely annoying to me because the market had slowed down pretty significantly since then. So I was really like, what the heck? Like, how am I just picked out the best homes I get. So everyone was bidding on those homes. But that's just the world that we live in. So in reality, today as a buyer, it's a better time for you because of the concessions that you're going to get from a seller in terms of price and also in terms of potential closing costs and rate buy down. So let's do the same thing that we did for the state of Florida, and we're going to take it back to 2008 and see where our active inventory was so that you can get the full picture of what's going on. So as you can see, we were just under 2,500 homes now. If you go back to 2008 and 2010, really, we were pushing north of 3,000, pushing towards that 3,500 home mark. So we still have a good bit of way to go to that active inventory. And as you saw in seasonality, when we typically hit the summer months, we should see inventory start to go down a good clip. So we're going to keep an eye on that. If inventory keeps climbing as we head into the summer, that's where we might start to have a little bit of a red flag moment. Like, hey, this is getting a little like, what's going on? Prices are going to start going down. But as of right now, the data doesn't show that. And just to wrap this up and put a bow on St. Johns County and the market here, I just took a look at median sale price just so you can see what's happened since the pandemic and how drastically things have changed and ramped up to 2022 and how they've kind of steadied since then, which, in my opinion, the last 3 years have been, extremely volatile in terms of the political situation, potential wars, inflation, mortgage rates. And now we're seeing our market kind of flatten out, which indicates to me that we have a strong real estate market here in northeastern Florida and shows that we still have relatively good demand regardless of all the factors out there. So you take a look at the St. Johns County median sale price, you take it back to 2020, you can see that things changed pretty drastically. We were just above $350,000 for our median sale price then, and then all the way up to May of 2022, we got just above $570,000, which it was a pretty crazy time during those past 2 years because things were appreciating month over month, year over year in double digits, which was insanity. And that's not typical. Like we saw for the Jacksonville metro service area, you should expect about a 5% appreciation rate year over year, not a 10 to 20% appreciation rate, which is what we saw. But since 2022, you can see that our market has pretty much evened out, and there's peaks and valleys to the real estate market, which is why we talked about seasonality earlier, right? You're going to have slower times where you're going to see pricing come down, and then you're going to have faster time where you're going to see pricing go up. And in our area, that's typically going to correlate with, like, the winter months is going to be the lowest time for pricing, and the summer months is going to be the peak for our pricing. And that shows just fine on this graph here, but you can kind of see that pricing is kind of not going anywhere, right? It's kind of in the same area, hovering around the 500 to 550 mark, really 525 to 550 mark in terms of our median sale price across the county. And no one can tell what the future is going to hold for St. Johns County, but what we can do is just look at the past. And if you take a look at the past 3 years, where we've had some extreme volatility in terms of wars and interest rates and all that kind of stuff, you can see that our market's held pretty steady. So if you can indicate for the future, I would say that we're going to see more of the same. Okay, so what is my prediction of what's going to happen here in St. Johns County as we go towards the end of the year? The first quarter is already done, and in my opinion, it was pretty slow. It didn't seem like there was a whole bunch of activity happening, and I think that was also around a whole bunch of uncertainty in regards to what President Trump is doing to the tariffs in terms of mortgage rates, war with Ukraine and Israel, and all that kind of stuff. There's just been a lot going on in all of our lives, and the news cycle has really honed in on that, and a lot of the YouTube doomers have as well. But what I think is going to happen here in St. Johns County is that we're pretty much going to see more of the same. The past 2 years, I think, are a good indicator of what this year is going to look like, unless we see a huge change in interest rates, right? Going down to 6.5%, that's going to bring more buyers to the market. Is it going to bring all the buyers to the market like we saw in 2021 and 2022? No, because interest rates aren't 3 or 4%. Really, it makes it way more affordable at those rates. But at a 5 to a 6% rate, that's when I think we're going to start to see the market take off pretty significantly. Now, there's several factors that go into that. Too many to cover in this video. I'm thinking that by the end of this year, we're probably going to see interest rates be around 6 to 6.25%. And that's just me being optimistic. Then in terms of appreciation by the end of this year, let's say even going into 2026, I think what we are right now is we're at a lull of housing. Typically, you're going to see, if you look at historical averages of sale prices in any area, you peaks and valleys of what happens with pricing. And typically when we go into a recession, and my full belief, we've been in a housing recession since January of 2022, you see things flatten out. Last year of 2024, we had the lowest sales in terms of closed sales across the entire country for 30 years, which I think is a good indicator that, like, hey, we're probably at the bottom in terms of home sales. And that as we move forward, things should tick up pretty slowly and surely. As more people get adjusted to the 6% interest rate, they get more comfortable with it, and just like, hey, if I want a house, it is what it is. This is what I have to go with. So here in our area, we do also have new construction builders, which add some fuel to the fire. You saw that our market here is about 30%, at least in St. Johns County. We have about 30% of our inventory is going to be new construction, which is a huge amount. And these guys are all throwing incentives left and right. You want to buy your interest rate down to 4.99%? Tons of builders are doing that. They're going to pay your closing costs on a $500,000 house. We're talking about like $17,000 to $20,000 that the builder's saying, like, here you go, take it. Buy this house, close on this home. We're going to buy it on your interest rate, and we're going to pay your closing costs. All you got to worry about is your down payment. That makes it a pretty easy situation for many people, because the main thing that's keeping people from buying homes today is the mortgage interest rate. And that's what my conversations are with many buyers. They're like, hey, I either need to save up more money so I can put a down payment down because I want to buy a house, or I got to wait for these interest rates to go down. You can only predict one of those, right? How much money you're going to save. Mortgage interest rates, we're just kind of taking a whole bunch of educated guesses here. So guys, that was a whole bunch of information. I know it was. If you have any questions about what I covered here, make sure you reach out to me and my team directly. Like I said before, all we try to do is give you the information so that you can make an educated decision on what you want to do. If you also want any of these slides that I've covered, I can send them to you personally. Just reach out to me directly, shoot me your email, your contact information, and I'll send it out to you. Until next time, guys, have a good one.